Welcome to Fairport Flash, the monthly economic update powered by the Fairport investment team. Our team gathers the most recent news, data, and research and distills it into the information most important to you. Let's get started.
Welcome to Fairport Flash. My name is Katie Sheehan, Portfolio Manager at Fairport. I'm primarily responsible for assisting in developing and implementing the firm's investment strategy with a focus on equities and impact investing. Given the headlines surrounding the recent U.S. Treasury yield curve inversion, we felt it was timely to discuss the three main factors we consider when determining our investment strategy, and those are the spread of the yield curve, economic growth, and corporate earnings. I'll start by defining what we mean by the spread of the yield curve. An often quoted indicator in financial news is the 10-year yield, and that's essentially the interest rate the government will pay to borrow money for 10 years. So the U.S. government borrows money across maturities such as 3 months, 2 years, 10 years, and so on, and the spread is measured as a difference between a longer maturity yield and a shorter maturity yield. The curve is considered inverted when the spread is negative, or in other words, when the interest rate paid on a shorter maturity bond is higher than that of a longer one. This occurred on March 22nd when the 3-month Treasury yield crossed higher than that of the 10-year yield for the first time since 2007. So why is this important? Well, an inverted yield curve has historically been considered a leading indicator of economic recessions with an average lead time of about 14 months. Typically, yields on longer-dated bonds decline due to lower growth expectations. However, as has been said about a lot of things in the past decade, this time certainly could be different, largely due to the term premium. The term premium is just one component of U.S. Treasury yields. Others include real yields, which are Treasury yields less inflation, inflation expectations, and then there's the term premium, or basically all the other factors impacting yields, such as yields on international bonds. Now, the term premium has remained near zero or negative since about 2014, and that's essentially placed a ceiling on those longer-dated bond yields. So back to the inversion. Since the 1960s, there have been 2 inversions out of 11 in which an economic recession did not follow, and that was 1966 and 1998. So that's to say that every economic recession has been associated with a preceding yield curve inversion, but not all yield curve inversions have been associated with a recession. It's likely current conditions resemble the 1966 inversion in which the term premium on bonds was consistently negative. In the near term, recession fears may be somewhat overdone, and our rationale ties into the next factor of our investment strategy, which is signs of an economic downturn. So first, taking a look at employment. Although the February employment report was disappointing, just 20,000 jobs were added, growth certainly bounced back in March with 196,000 jobs added. While at the same time, initial jobless claims just this week fell to the lowest level since 1969 after hitting a low last week as well. So with a consistently low unemployment rate and quit rates remaining elevated, the jobs picture remains pretty healthy and it's not yet showing signs of significant weakness. Another predictor of economic stress are increasing corporate bond spreads. This measures the difference in yields between low-quality and high-quality bonds. Now, despite the yield curve inversion, the corporate bond spread has actually been steady to declining in recent months, which is considered a pretty positive sign for the economy and the equity market. And now, while I could spend hours on domestic economic indicators, the last one I'll discuss is a favorite of Fairport's CIO, John Silvis, and that's the Evercore ISI Trucker Survey, which is considered a leading indicator of industrial production and generally has a direct tie to GDP. This is just another measure that was showing some signs of weakness to start the year, but has ticked higher recently. So considering all the economic indicators we look at, including some that weren't mentioned here, we do remain fairly positive on the U.S. economy in the near term. And it appears even global growth has been showing some signs of life lately, despite headline economic reports across the pond. You're seeing the copper to gold ratio, which is an indication of global economic output and a strong coincident indicator of 10-year Treasury yields, has been increasing as well. And this brings me to our last factor, which is corporate earnings. Generally, an earnings recession is defined as 2 quarters of negative earnings growth. Similar to inversions, every economic recession has been associated with an earnings recession. However, an earnings recession can occur without an economic one. Such was the case in 2015. Now, first quarter earnings are slated to begin this week and are expected to decline about 4% from last year. Companies do have a tendency, however, of beating estimates by on average around 5%, so that could bring that growth to around neutral. So it's possible we could experience some weak earnings reports this quarter, but really we'll be keeping a closer eye on forward guidance to determine if an earnings recession is truly ahead or if the first quarter is the exception this year. Current second quarter earnings estimates are positive, but analysts are likely to adjust as companies report in the coming weeks. So just to reiterate, we remain relatively positive on the economy and the equity markets in the near term and maintain a modest overweight to equity on our asset allocation guidance. Now, that's not to say that there won't be some bumps along the way this year. In fact, history has shown that when the S&P has been positive in each of the first 3 months of the year, so that's positive returns for January, for February, and for March, the market's generally positive for the year with an average return of about 9.5%. But, of course, we would caution that during the year, historically, there's typically been a correction of varying degrees with an average drawdown of about 9.5%. So, like I mentioned, there's likely to be some volatility ahead. But again, we'll continue to monitor these factors that I mentioned, the yield curve, economic indicators, and corporate earnings in order to adjust our investment strategy accordingly. So this brings us to the close of today's Fairport Flash. As a reminder, our goal at Fairport is inspiring families, and as a member of the investment team, we strive to do this through a long-term diversified approach. If you'd like to discuss any of today's general topics in more detail, please reach out to your Fairport advisor. Thank you for listening, and keep an ear out for the next Fairport Flash next month.